So, before the break I was talking about the pricing of bonds with reference to yield curve, which is upward sloping where the spot yields are increasing with maturity. In this case, the simple or straightforward approach that we encountered by solving the previous example would not really hold, and what we will find is that with a sloped yield curve, it may not always be true that the price gradually decreases as we move towards the maturity. Now, if the yield curve is upward sloping, the roll down yield and the roll down return will be higher than the start of the period YTM. I will illustrate this with an example, bear with me for the moment. Why is that? I also explained before the break, but let us read it out again. For an upward sloping yield curve, the yields at the end of the holding period based on the term to maturity less the investment horizon will be lower than the t equal to 0 yield, which is based on a longer term to maturity, because the longer the term to maturity, the higher will be the spot rates that would come into the picture, that would be involved when we do the pricing. For example, if you do the pricing of a 1 year bond, you are only having H01. If you do the pricing of a 2 year bond, you are having H01 and H02, and please note H02 is greater than H01 because you are talking about an upward sloping yield curve. So, the point is, when you at t equal to 0, suppose you have a 10 year bond, you will be using the 10 year rates with H01 less than H02 less than H03 and up to H010. But at the end of 1 year, it will now become a 9 year bond, and therefore, you will use, assuming that the rates are unchanged, you will use H01, H02, H03 up to H09, and you will ignore H010, it will not come into the picture, and it so happens that H010 is the highest rate. Therefore, the price, when you work out the price at the end of 1 year, it will be based on the lower interest rates. That is the issue. So, that is what is meant by this particular paragraph. For an upward sloping yield curve, the yields at the end of the holding period based on term to maturity less the investment horizon. End of the holding period, what is remaining? Remaining is the maturity minus the investment horizon. That leftover, you see, let me draw this timeline. This is 0, this is H, and this is T. Now, when you are evaluating the price of the bond at t equal to 0, you are looking at all the cash flows that occur up to capital T, and they will be, you will be using the spot rates corresponding to each of these cash flows, timing of these cash flows. But when at the end of the holding period, at the end of the investment horizon, you are at this point. Now, at this point, the maturity of the bond has now become t minus h years. So, you will be using H01, H02, H03 up to H0 t minus h, and it so happens that H01, H02, H03 t minus h gradually increase, and therefore, when you were here at t equal to 0, you had more cash, more discounting periods, and the discounting periods which are ignored when you are at t equal to h are those discounting periods which happen at a higher discount rates, higher interest rates, and as a result of which the YTMs corresponding to this to the bond at this point will be lesser than the YTM corresponding to this point. That is the point. So, for an upward sloping yield curve, this is very important, this is very fundamental. For an upward sloping yield curve, because upward sloping yield curves are the order of the day, that is not, that is called a normal yield curve, where the spot rates increase as maturity increases. For a upward sloping yield curve, the yields at the end of the holding period based on term to maturity minus investment horizon will be lower than the t equal to 0 yield. Why? Because t equal to 0 yield also has the spot rates corresponding to from t minus h onwards up to capital T, and all of these are more than the rates which are earlier. So, will be lower than t equal to 0 yield, which is based on a longer term to maturity. Thus, the bond value at the end of the holding period will be higher at a lower, because it is at a lower YTM than at t equal to 0. The bond value at the end of the holding period will be priced at a lower YTM than the YTM at t equal to 0. Let us do this illustration. I think this will clarify what I have been trying to say. Assume 10%, assume a 10% 2-year annual coupon bond, face value is 1000. Calculate the current price and the price at the end of 1 year, assuming that the yield curve is upward sloping with S01 equal to 6.21% and S02 equal to 15.50%. So, clearly it is an upward sloping curve. S01 is much smaller than S02. So, it is a steep upward sloping curve. Assume that the rates at t equal to 1, this is important, this is also I mentioned it several times. We assume that the yield curve remains unchanged, the rates do not change at t equal to 1 or at the end of the investment horizon. We are faced with the same yield curve which we faced at t equal to 0. Assume that the rates at t equal to 1 year for various maturities are exactly the same at t equal to 0. Let us see how we solve this problem. The price at t equal to 0, that is equal to C 1 upon 1 plus S 01 plus C 2 upon 1 plus S 02 square. The coupon rate is 10%, face value is 1000. So, this is 100 and the 1 year spot rate is equal to 6.21%, right. And at the end of the second year, what will you get? You will get the coupon and you will also get the redemption of the principal. So, the total cash flow will be 1100 and it will be discounted at S02, which is 15.50%. The value that we arrive at is 918.72. So far no issues, no problems, it is quite straightforward. Now, at P1, when you reach P1, what will you get? You will get at the assuming that the coupon at t equal to 1 has already been paid off. So, the only cash flow that remains from the bond is the 1100 that will be paid at t equal to 1 year from now, t equal to 2 from t equal to 0, but now you have already crossed 1 year. So, there is 1 year left up to the maturity of the bond. So, the cash flow is 1100, assuming I repeat the coupon, this coupon has already been paid, assuming that this has been paid at t equal to 1. So, the pricing is after the payment of the coupon, and now we have got this amount is going to be received at the end of 1 year, at the end of 1 year from now. And therefore, you will discount it at S01 and we assume that the interest rates have not changed. So, S01 is nothing but 6.21%. So, this gives us a value of 1035.63. This is the value at t equal to 1, assuming that the yield curve has not changed. We face the same yield curve, but we are left with only 1 year to maturity. So, the relevant spot rate will be S01 and S01 happens to be the lowest rate, that is 6.21%. And when we work out the return, what return we get? 1035 is the price at which the bond will sell in the market, plus 100 is the coupon that I would have received. So, 1035 minus plus 100, and what would be my investment? My investment is 918 at t equal to 0. So, that gives me 23.61% return. This is much more than the spot rate of 6.21%. Please note this important feature. Had it been a flat yield curve, you would have got a return of equal to S01, that is the spot rate. But because if it is an upward sloping yield curve and we are assuming that the spot rates do not change over the life of the investments, we continue with the same yield curve. It means that the yield is turning out to be much more, that is 23.61%, and the yield of between the period t equal to 1 and t equal to 2 turns out to be 6.21%. So, this is the anomaly that we encounter when we are faced with an upward sloping yield curve and which distinguishes itself from a situation where we have a flat yield curve. Now, let us look at another situation. Assume a 10% 2-year annual coupon bond, calculate its current price and forward price. Please note the words are forward price, this is different, this is a different problem at the end of 1 year, and calculate the interest rate and calculate the forward yields. Now, if you look at this problem, as far as the first part is concerned, it is same, no issues. As far as the second part is concerned, the price at the end of 1 year, the forward price, please note this, forward price at the end, this is the forward price at the end of 1 year will be given by C 2 divided by 1 plus F 12, and that is given as 875 plus a 83, where we use the arbitrage free methodology or arbitrage free relationship for calculating the forward rate, and we find that the return over the as t equal to 0 to t equal to 1 is equal to the spot rate, and the return over t equal to 1 to t equal to 2, the forward return, the forward yield over t equal to 1 to t equal to 2 is equal to the forward rate, as mentioned earlier also in today's lecture. Now, let us talk about yield spreads. Again, this is more of a revision, more of a recapitulation before we get into bonds, bond portfolio management, fixed income securities portfolio management. A yield spread in general is the difference between the yield between two fixed income securities. Let me repeat, a yield spread in general is the difference in yields between different fixed income securities. Yield spreads over benchmark rates, yield spreads over benchmark rates. Again, I repeat, this is more of a revision, so let us do it quickly. In fixed income security analysis, it is important to understand why bond prices and yields to maturity change. To do this, it is useful to separate a yield to maturity into two parts. Number 1, the benchmark, and number 2, the spread over the benchmark. So, the YTM of any particular risky bond can be split up into two parts, the benchmark yield and the excess over the benchmark yield, which is called the spread. The benchmark yield for a fixed income security with a given term time to maturity is the base rate, often a government bond yield, often a government bond yield. The spread is the difference between the yield to maturity and the benchmark rate, whatever that benchmark rate you choose. If it is a fixed rate bond, usually we use the government bond yield, and if it is a floating rate bond, we use LIBOR. That is usually the case, not necessarily so, of course, and the difference between the yield YTM on the fixed income security or the risky security and the government corresponding maturity government bonds is the yield spread over the benchmark. The yield spread over a specific benchmark is referred to as the benchmark spread and is usually measured in basis points. 1 basis point is equal to 0.01%, that is 1 upon 100%. If no benchmark exists for a specific bond's tenor or a bond has an unusual maturity, interpolation is used to derive its implied benchmark. Also, bonds with very long tenors are priced over the longest available benchmark bond. For example, 100-year bonds, often called century bonds in the United States, are priced over the 30-year US Treasury benchmark rate. Interpretation of the benchmark rates, and this is interesting. The reason for the separation is to distinguish, that is, the benchmark and the spread over the benchmark. The reason for the separation between the benchmark rate and the spread over the benchmark rate is to distinguish between macroeconomic and microeconomic factors that affect the bond price and therefore its YTM. The benchmark captures the macroeconomic factors, the expected rate of inflation in the currency in which the bond is denominated, general economic growth and the business cycle, foreign exchange rates and the impact of monetary and fiscal policies. So, all these macroeconomic issues are captured by the benchmark rate. Let me repeat, the benchmark captures the macroeconomic factors, that is, the expected rate of inflation in the currency in which the bond is denominated, general economic growth and the business cycle, foreign exchange rates and the impact of monetary and fiscal policies. Changes in these factors impact all bonds in the market, and the effect is usually seen as changes in the benchmark yield. So, if there are changes in the macroeconomic factors, in the factors that influence the whole economy of a nation, that would manifest itself as changes in the benchmark rate. As far as the spread is concerned, the interpretation of the spread is rather elementary, it is rather obvious. It is the microeconomic factors, the factors that relate to the specific instrument that we are talking about, which are captured in the spread. So, let me quickly read it out. The spread captures the microeconomic factors specific to the bond issuer and the bond itself, like the credit risk of the issuer, changes in the quality rating on the bond, liquidity and trading in comparable securities, and the tax status of the bond. All these things contribute to the level of spread, extent of spread of the risky bond over the benchmark bond. It should be noted, however, that general yield spreads across issuers can widen or narrow with changes in macroeconomic factors. Components of the yield: it is usual to segregate the yield into two major components. Let us talk about them. The benchmark is often called the risk-free rate of return. The benchmark rate is often called the risk-free rate of return. Also, the benchmark can be broken down into the expected real rate and the expected inflation rate in the economy. So, basically the benchmark rate captures two factors. Number one, the real rate of growth, or the real rate of increase, or the real rate of increase in the economy, and number two, the expected inflation rate over and above the real rate. So, in a sense one can say that the benchmark rate is the price that one pays for the sacrifice of the utilization or the enjoyment or the use of a commodity for a given period. That is the basic rate, and then you add to that the inflation premium, you get the benchmark rate, and you add to that the risk premium, you get the rate for the risky security. So, that risk premium is basically the yield spread. So, also the benchmark can be broken down into the expected real rate and the expected inflation rate in the economy. The yield spread is called the risk premium over the risk free rate of return. The risk premium provides the investor with compensation for the credit and liquidity risks and possibility of tax impact of holding a specific bond. So, as far as the benchmark rate is concerned, it captures the basic rate, the basic sacrifice of enjoyment, postponement of enjoyment rather, postponement of utilization of the money, and also the inflation. The benchmark rate captures these two contributors to the time value of money, and the risk is captured by the spread. So, these are the YTM building blocks. You can see here, this is the spread, and the spread is the risk premium, and you can see here, as far as the benchmark goes, this is the risk free rate of return, and the risk free rate of return is determined by expected inflation and expected real rate. So, that is, and as far as the risk premium is concerned, it is captured by, or it is determined by taxability, liquidity and credit risk of the instrument. The benchmark varies across financial markets. Fixed rate bonds often use a government benchmark security with the same time to maturity as, or the closest time to maturity to the specific bond. The benchmark is usually the most recently issued government bond and is called on the run security. On the run treasuries, this is a term which is very often encountered. So, let me read out the definition of on the run treasuries as far as benchmark spreads are concerned, as far as benchmarks are concerned. So, the on the run government bond is the most actively traded security, government security, and has a coupon rate closest to the current market discount rate for that maturity. That implies that it is priced close to its par value. Seasoned government bonds are called off the run. On the run bonds typically trade at slightly lower yields to maturity than off the run bonds having the same or similar times to maturity because of differences in demand for the securities and sometimes differences in the cost of financing the government security in the repo market. So, on the run securities are securities which are most actively traded securities, and essentially they are securities which are issued latest by the government, by the appropriate issuing authority. Now, we talk about fixed income portfolio management. Before we talk about fixed income portfolio management, let us see how income is derived out of an investment in a fixed income security. So, we start with the modeling of fixed income return. I illustrate this with a comprehensive example. So, let us start with this example. A fixed income analyst wishes to forecast the expected return on a bond portfolio for the next year. He gathers the following information and assumes no reinvestment. This is interesting, and we will encounter this later on when I solve this example. So, he gathers the following information and assumes no reinvestment of the coupon cash flows. Average coupon rate of portfolio is 3%. Average coupon rate of portfolio is 3%. Coupon frequency is semi-annual. Horizon analysis is 1 year, the holding period is 1 year, and average bond price of portfolio, that is P0, that is equal to 101.500. Continuing, the average life of the bonds across the investment portfolio is 7 years. The YTM corresponding to the price of 101.500 is 2.76% per annum. This is given, and further assume that the initial curve is upward sloping and the 6-year bond yield is 2.56%. Please note, the life of the bond, the life of the investment portfolio is 7 years. You are holding the bond for 1 year, and at the end of the 1 year, when you are going to dispose of the bond, you will be faced by the same yield curve, but with a maturity of only 6 years, because the bond has a remaining life of 6 years, 1 year has already elapsed. So, naturally the yields would change. When you talked about the 7-year investment, that is at t equal to 0, the YTM was about 2.76%. Now, when you have moved 1 year further, you face the same yield curve, but because the life of the investment is reduced from 7 year to 6 year and it is an upward sloping yield curve, you face a lower YTM, and that lower YTM is 2.56%. A bond pricing model may be used to project the price of the 7-year bond to in 1 year when it is a 6-year bond. This is important, when it is a 6-year bond and priced at 2.56% yield. Assume that the projected price of the portfolio in 1 year, if yield curve is unchanged, i.e. at a YTM of 2.56%, turns out to be 102.419. So, this is the price at t equal to 1 when faced with the same yield curve, using the fact that the bond has a remaining life of only 6 years, and therefore, we need the 6-year maturity rate and not the 7-year maturity rate. The analyst projects that a general decline in interest rates of 50 basis points is likely. A decline in credit spreads is expected as well. Combining the credit spread decline for the portion of the portfolio in credit risky bonds with the general 50 basis point decline, the analyst projects a 54 basis points. So, the 50 basis points is the general decline across all instruments. Then there is also a decline specific to certain risky securities in the portfolio, and that when adjusted or when accommodated over the entire portfolio can be considered as a further 4 basis point decline. So, the total anticipated decline on account of the general effect and the effect due to a decline in credit risk or decline in credit spreads rather is 54 basis points. 50 basis points for the general decline and 4 basis points for the decline in credit spreads, which is obtained by apportioning the impact on the credit risky securities in the portfolio over the entire portfolio. The expected yield and spread change of the portfolio delta y is minus 54 basis points. That is what I mentioned just now. The modified convexity is given as 28 and the modified duration is given as 5.60. There is further information as far as credit losses are concerned. The analyst estimates 0.071% of the portfolio bond value will default and 15% of any defaulting value will be recovered. So, 85% will be lost. If any bond issuer defaults, 85% will be lost, 15% will be recovered, and the fraction in terms of money value of defaults is equal to 0.071%. Then expected gains or losses versus investor currency. The portfolio is invested 40% in foreign denominated bonds and the investor expects the foreign currencies weight to reflect portfolio exposures to appreciate 3.925%. So, this 3.925% is going to impact only 40%. Please note this point. It is not the overall increase, overall return, overall increase in value, it is the increase in value for 40% of the assets which are in foreign denominated bonds. So, as far as the income yield is concerned or the current yield is concerned, it is straightforward. The total amount that you receive for the year is how much? You receive 1.5 at t equal to 6 months, and you receive another 1.5 at t equal to 1 year, and that gives you the total coupon payments for the year is 3.00. The current market price of the portfolio is 101.50. So, the current yield or the income yield, as you may call it, is 3 divided by 101.50, that is 2.956%. So, because this example assumes no cash flow reinvestment, it does not matter that the coupons are paid semi-annually. There is no adjustment for reinvestment here. With a 3% annual coupon rate, 1.50 will be received in 6 months and 1.50 at the end of 12 months. Total coupon payments collected 3. The current market price is 101.50. So, the yield turns out to be 2.956. If you want to work out the 6-month periodic return, you simply divide it by 2, you get the return as 1.478%. As far as reinvestment return is concerned, please note we assume no reinvestment, so no reinvestment return will be there. However, if there were if let us assume for example for the purpose of illustration that if there is a 2% if the coupon payment at t equal to 6 months is reinvested at the rate of 2% per annum, that is 1% for the half year. The coupon at t equal to 6 months will be reinvested for only 6 months, because 1 year is the holding period, 1 year is the investment horizon, and what you will get is 1.5 into 1%, that is 0.015% of return. This would be an add-on had you reinvested your coupon received at t equal to 6 months at the rate of 2% per annum for the next 6 months, that is up to the end of the holding period. Had you done that, you would have got this additional return. 1.5 is the coupon payment, the interest rate, periodic interest rate is 1%. So, 1.5 into 0.01, that gives you 0.015% of return. Roll down yield, this is the most important part. Roll down yield relates to a bond pricing model assuming that the yield curve is unchanged, just as we did in the example. So, the portfolio, let us assume that the portfolio is made up of only a 7-year bond priced at a yield of 2.76% at t equal to 0, and the price at t equal to 0 is 101.50. So, let me repeat, at t equal to 0, the maturity of the bond is 7 years, the YTM is 2.76% and the price is 101.50. It is also given that the at t equal to 1, that is at the end of the investment horizon, when the investment horizon is over, then the yield that we face for the 6-year bond or the YTM for the 6-year bond is 2.56%, and corresponding to this 2.56%, the market price anticipated is 102.419. So, what is the yield? What is the rollover yield? It is given by the end of horizon period projected price minus beginning price divided by beginning price, that is 102.419 minus 101.50 divided by 101.50, that is 0.905%. So, this is the way we work out the roll down yield or the yield that corresponds to the slope of the yield curve. The components 1 and 2, that is the income yield or the current yield and the roll down yield, are sometimes aggregated and they are called rolling yield. So, in our case it happens to be 2.956 plus 0.905, that is equal to 3.86%. Note that if the yield curve is flat and a bond is initially priced at a premium discount, we have discussed this point, the projected price at the end of 1 year will be lower than the startup period price as the bond price is pulled to par to expiration. With a slope, let me reiterate this, I have already explained it in a lot of detail, but it is so important, let us read through it once more before we conclude. with a sloped yield curve, that may not always be true in the shorter run, that is before maturity. What may not always be true? This particular point that we have on this slide, the yield curve is not flat. If it is an upward sloping yield curve, the pulling down of the amortization of premium oblique discount may not be as accurately reflected in this particular statement. If the yield curve is upward sloping, the roll down return will be higher than the startup period YTM. The roll down yield will be higher than the startup period YTM. This is because, this is the catch, this is the important part. This is because the bond price PH at the end of the holding period, that is holding period is t equal to 0 to t equal to h, will be worked out at a lesser term to maturity, that is t equal to h to t equal to capital T, that is t minus h years. At the end of the holding period, at the end of the investment horizon, the remaining life of the bond will be less than the price at t equal to 0, where the bond price will be worked out over the entire period from t equal to 0 to t equal to capital T. Because the curve is upward sloping as per our assumption, the shorter end rates are lower. Thus, the rate for maturity of t minus h will be lower than the rates for maturity of t equal to capital T. Thus, the price calculated at exit at t equal to h will be at a lower rate, and hence the price will be higher. So, from here we will be continuing in the next lecture. Thank you.